today it's up again by another 1.5%. The pound, meanwhile, well, that jumped straight after the exit poll at 10 p.m. on Thursday evening. Today it's still ahead, although albeit rather less spectacularly. So what's behind this market reaction? What's next, especially with a year of more Brexit trade negotiations ahead in 2020? With me now, the senior UK economist at Capital Economics, Ruth Gregory, asset management, global market strategist, Mike Bell. Afternoon to you both. Ruth, let me start with you. I mean, big rise in the pound.
I think that we did see that initial jump in the pound following the election result, and that reflects the fact that Boris Johnson can push his Brexit. GDP growth and further rises in sterling. So much of that gain that we've seen in the pound from 131 against the dollar to around 134 now, you may start to see markets focus shift very quickly away from a relief that a Brexit deal was passed to more concern about a potential no-deal Brexit, or something close to that on the 31st of December if that transition period isn't extended and a trading agreement isn't agreed by that point.
Yeah, there was an awful lot of speculative money weighed against the pound. It looks like a lot of those bets seem to have unwound, doesn't it?
Yes, I think that the clear, we've yet to see the big decision, the crucial decision next year. What will the UK's trading relationship with the EU look like, and really how big that fiscal stimulus will be, and how much that will encourage a pickup in GDP growth next year.
And Mike, it's a pretty similar story there UK equities have been on an absolute tear since Friday morning. Are people getting a bit carried away with the optimism?
I think what you've seen is that since the referendum, a lot of money came out of UK equities, so flow was very negative. And then a few months ago, it started to edge back in. Now, with the result of the election, I think you're going to see more of that money that came out since the referendum going back in, and that could help prop up UK equities, because relative to developed market equities, they look pretty cheap.
Yes.
P on the FTSE 100, much lower than, say, on the S&P 500.
How much of that's the fact that the UK was at a discount to developed markets, how much is it the fact that if you take the FTSE, it's a pretty defensive index anyway, isn't it?
Yeah, well, so I think a lot of it was political risk, and that's why I think you could see some of the money come back in. You saw that on Friday with the utility sector, for example, with the risk of nationalisation being removed, a big jump in the share prices there, for example.
What about some of this pump priming that we hear that Mr Johnson is going to be doing? Are there specific sectors that you would be looking at as an equity investor right now?
Well, I think that fiscal stimulus should help support the consumer. You've got wage growth that's picking up quite nicely. So some of those more domestic-focused stocks, some of the consumer discretionary stocks could, if consumer confidence picks up, benefit from this fiscal stimulus and the support it should give to the economy.
Ruth, what about the gilt market, UK government bonds? I mean, clearly both parties were looking at big increases in government spending. I mean, there is more borrowing implied, isn't there? What does that mean for gilt issuance?
I think that we are looking at a fairly big fiscal stimulus coming perhaps in the budget in February, but I think there is perhaps little upside for gilt yields and for interest rates, just because if businesses do fear this this deadline on December 31st at the end of 2020, then lingering Brexit uncertainty really can put business investment on ice. So any real pickup in GDP growth and higher interest rates really on the back burn until 2021, we think.
You agree with that, Mike? I mean, is there any justification for the Bank of England now maintaining this dovish stance that it's had?
We think they should drop the dovish stance. I think the likelihood of rate cuts becomes much less likely, but I would agree that they're unlikely to be putting rates up. So I don't think you're going to see a material backing up in bond yields, given that they're likely to be on hold throughout the rest of next year.
The other interesting piece behind the stronger sterling story, I guess, is that this is potentially good news for inflation, isn't it?
Yeah, so you've seen sterling up quite a bit now, actually, over the last few months. So that should feed through into lower inflation. Combine that with rising wage growth, and real income should start to pick up quite nicely. So that should help prop the UK economy up, which is necessary given some of the weakness we've seen in some of the business surveys over the last few weeks.
Absolutely, yes, and including
that was pretty much what all analysts were expecting. So it's a figure that is completely respectable and grounded.
Stories now, and the Independent Office for Budget Responsibility has restated its forecast for UK government borrowing. The OBR now expects an extra £20 billion worth of borrowing in each of the next 4 years. It said it had restated its forecast from March this year to include recent changes made by the Office for National Statistics, but that it had not incorporated any other new data or judgments. Well, the restatement was due early last month, but it was postponed due to the general election. Cinema operator Cineworld is buying Canadian rival Cineplex for £1.6 billion, including debt. The deal will make Cineworld, which currently makes 3/4 of its revenues in the US, the largest cinema operator in North America. Well, the deal gives Cineworld a 0.75% market share of Canadian box office receipts. However, as Cineworld currently has no operations in Canada, the deal is not expected to face any opposition from competition regulators.